Sanjay, would the nature of over the next 18 months, would the nature of the participants from, if there is a correction, and from that correction, if we were to rise higher because of led by economic growth, etc., would the nature of the participants change? Again, a fair degree of argument currently, as has always been the case, maybe, but more so currently, because growth stocks are so valued primely, that the nature of the components would change, and themes naturally change, but the basic nature of value versus growth will change for the next 18 months. Would you second that, or not quite?
I'm not so sure that will happen. I would love for that to happen, Neeraj, because we've all been trained in colleges on DCFs and capitalizing asset pricing models. That doesn't seem to be working at the moment, at least in the traditional sense. If you go back in history and look at investing from 1970 to 2010, value in total returns has always outperformed growth, right? Apart from brief periods of volatility. It is only post the GFC that you see sustained growth outperformance. And again, goes back to the original point I was making, that it is the cost of capital that drives these valuations or these styles differently, right? If you think of equities as a cash flow stream, a growth equity has a higher duration than value. That is why when cost of capital falls, growth does better than value. So it makes complete arithmetic sense in a way. And if you think of it that way, only environment or only reason why value will start outperforming growth is if the cost of capital starts to rise. Okay, then duration will get sold off or growth equities will get sold off. And apart from little bit of normalization, I don't think global economy is in a place where you'll see significant increases in cost of capital for the next few years.